Welcome back to another episode of the Black Bullion Show. How do we establish support and resistance levels for gold? One word, Fibonacci. Now, you might have seen this video done before using silver. This time we're going to talk about gold. So before we begin, I just want to say if you are new to this channel, please subscribe and also please give this video a like to help get this economic evangelism out there to the masses. And also, if you want to just get a quick video synopsis without watching this full video, because this will be pretty technical, use the description below to see to get a quick synopsis. So let's get into it. I'm not going to be talking about the background of Fibonacci. I'm not going to be talking about the golden ratio, but I'm showing you this here so you guys can get a feel or get an idea of whatever that what that is, and I will link this Kitco education page in the description as well for you to check out and do your own research on Fibonacci. But just know that traders use it to trade. Now, we are going to do some forecasting of the gold price based on recent price levels. So, quick disclaimer, the Fibonacci retracement should be done in conjunction with other metrics and tools. So let's assume we are currently in a large upward trend in gold. We had an average low on March 19th around $1,471.47. We had an average high on April 14th around $1,726.40. So how do we know if gold will move up or down? We know this based on short-term traders who trade Fibonacci retracements. What are Fibonacci retracements? It's a short-term price correction during an overall larger trend upward or downward. Why do they occur? Primarily because it becomes a self-fulfilling prophecy. Many short-term traders know other traders trade Fibonacci retracements. An unspoken order to the chaos of markets is established, and traders begin to watch out for key peaks and troughs, i.e., support levels or resistance levels within a particular range of prices. Here are the percentages, i.e., peaks and troughs, that many traders pay attention to. 38.2% of the range, 50% of the range, and 61.8% of the range. With gold, we have a range of 254.93. How do we get that? Remember, we subtract the low from the high in the range that we chose. So we chose a range between a date in March and a date in April. So that is our range, and this is of dates, and this is the actual numerical range when you subtract the prices. So 38.2% of 254.93 is 97.78, and so on and so forth. So what do we do with these numbers? We subtract them from the peak price of $1,726.40. The results will be potential support levels of gold. At the 38.2% level, we will create a support level at $1,628.82. At the 50% level, we will create a support level at $1,598.94. At the 61.8% level, we will create a support level at $1,568.85, or I should say $1,000.85. So if gold begins to trend upward and pulls back past 38.2%, there may be a possibility that the upward momentum has ended. So remember, if gold goes past $1,628.82 and goes lower than this, then there may be a possibility that the upward trend may not have legs. If it goes below And same thing too, if it happens with the 50% level, there's an even higher chance, and an even higher chance that that upward momentum will end. And short-term traders will establish stop losses just below these percentage points to prevent themselves from losing more money. So remember, the upward trend is over, or is likely to be over, if it goes below this number. So a short-term trader will then establish a stop loss right below this. So say at maybe 1620, they might put a stop loss there. Or another trader might put a stop loss at 1590. Moving on. So how do we forecast upward movement? Well, traders establish take profits similar to stop losses, but the opposite, at Fibonacci percentages above the peak. So let's do a little forecasting of where gold could be. Remember that we have the following percentages, as you can see here. Instead of subtracting them from the peak, we will add them on top of the peak. So at the 38.2% level, we will create a resistance level at $1,823.78. Don't we want to see that? Or even better, at the 50% level, we could have a resistance point or resistance level at $1,853.47. And with 61.8%, a resistance level at $1,883.9.95. Now, traders may also establish take profit points at the following percentages. So instead of these percentages, they may actually take profits at these percentages. So 138.2%, 150%, and 161.8%. I'm not going to go into why these numbers are important, but definitely check out that article to get a better understanding. So let's add 138.2%. We will create a resistance level at $2,778.71. At 150%, we will create a resistance level at $2,108.80. At 161.8%, we will create a resistance level at $2,138.88. Now, you guys may be thinking, well, that is a large number, Black Bullion. How is that even going to be possible? Now, remember, this is over a given period of time that these actions will occur. I'm not sure when. Now, there are those such as Chris Vermeulen and others who have proprietary Fibonacci models that will help them to predict when these moves may occur. I'm just saying that these are potential resistance levels based off of Fibonacci modeling. And also remember, you can't just rely on Fibonacci retracements, though many people unfortunately do. You need to also take into account other metrics to help you establish resistance and support levels. So what do you guys think? Let me know in the comment section below. I hope you enjoyed this video. Please give it a like. Please also subscribe if you're new. Thanks again for watching. It's Black Bullion.